Okay, hi everybody. Well, I just want to start with some announcements and hints. And this is, well, just what we are doing here. What is all this about and why we are doing the things we are doing here? Because, yeah, what is the reason to have this lecture in macroeconomics? You should be after this. It should be possible for you to read economic news, to think about it, to know, well, the argumentation is like this. Well, this I have heard. There, I know what is economic growth. I know what is inflation. I know how an unemployment rate is measured. I know what is a business cycle, and so on, and so on, and so on. Well, in Germany, we have the so-called German Council of Economic Experts. These are 5 guys, and they, by law, are writing a report every year, and this report is then handed to Mr. Scholz right now, and this was done yesterday at 12 o'clock. And here you can download this annual report they've written this year. And yeah, this is a perspective for the German economy in general. I think it is about 500-600 pages. So they are dealing at least with almost every interesting, economically interesting part of our country. And there, of course, in the content, you will find something like our magic square. So they are looking at economic growth, at inflation, labor market, international relation, and so on and so on. And then, of course, they are also dealing with what then I said, what we can have for further aims, the income distribution, then, of course, sustainability. This deals then, of course, with the energy, with the climate as a whole, and so on. So, yeah, have a look in this, and hopefully you will find there many aspects we are also talk about, and hopefully you have a better understanding because you are in this lecture. Yeah, and related to this, I already mentioned it in the Google room that I invited 2 guys to give a talk this semester here. The first one is in, yeah, roughly 2 weeks, or no, 1 week, that Mr. Ran is joining us. And yeah, he has worked very long in a private bank in the investment part, and his task was more or less, when should we change our portfolio in the direction of stocks or to securities? And if you remember, we already also talked about the dependence between securities and stocks and government bonds, especially that we have these inverse um, direction between interest rates and prices at the stock markets. Well, and about this we will talk together today. Is also that within a crisis business cycle, we expect more or less low interest rates. What does this mean for my investment decisions in general? So this was his part. Then afterwards, he worked for some private office, one of these very rich families we have in Germany. And now he wants to start his own business. And well, we are also related because he was also in the staff of the German Council of Economic Experts. And I have to say, I have learned very much from him. He is a little bit older than me, and yeah, he was maybe the head of the business cycle part of the staff of the economic experts during his time. And I think it will be very interesting if you want to join this, because, of course, it is a very macroeconomic, so to speak, topic he is talking about. Because right now, actually, in Germany, we are in a recession. And this you can also look at a global perspective. Where is the global economy? Where is in the business cycle the United States are going in the next month, the next years? And there we see, in general, we have a downturn globally. And now the question is, do we manage it? Like in the business cycle, after a downturn, there comes the upswing, or will be the downturn longer? This is the main question, more or less, and especially for Germany, since in Germany we are the only country within the Eurozone which are, so to speak, also technically in a recession. We are the only country where the GDP, real GDP, is going down. In all other countries, you have positive growth. So he will, in a practical, from an investment view, talking about this. And the other one is of Christopher Zuber, and he is an actual member of the staff of the German Council of Economic Experts. And here you see he is directly related to the macroeconomic part. So yeah, I think he is one of the main guys who did the actual forecast of the council, together, of course, with the 5 upper guys. Well, this will be in German, but of course he also speaks English. And if you hear this talk, and you can for sure also post then if you want questions in English. Okay. Uh, no, I don't think that I will record it, because then you have also always the problem, do you really want it, that it will be recorded? And this is not my decision, because these are other guys. And therefore. Okay, so hopefully I will see some guys of you within these talks, and then we want to move on in our topics. And there, when I found my mouse, we talked about money in general. We talked what is money today, and there, please keep in mind, money today is more or less a promise which we are giving to ourselves. And then we talked about, yeah, what is, so to speak, physically money today, the different aggregates, M0, M1, M2, and M3. And there, of course, we have to keep in mind, it is not only cash money. Especially cash money is the lowest part of money today. And about this we will go on to talk today. Then the amount of money, there we roughly estimated, okay, we have an amount of money, M3, 16 billion euros, which is roughly the GDP of the Eurozone. And this is then related with one point of view, how to explain the existence of money, how much money we have. This is the theory of quantity theory of money, where we then that just M times V equals P times Y. And if we take this view very drastically, then we come to the very famous statement of Milton Friedman, maybe one of the most famous neoclassical economists in the last century, Nobel laureate 1967, 76, and he posed it like inflation is always and every year only a monetary phenomenon. So this means more or less that P times Y equals M is interpreted as an identity. So he even doesn't say it is a theory and the theory can be applied or not. He just say, well, it is just like a balance sheet, one side and the other side, and by definition they have to be the same. Well, we will see later on, at least from my point of view, that okay, this view can be okay, but in my opinion, it is more long-term view, and that in short term, in practical situations, we see that it can be different. It can differ from this situation. Okay, and then we ended yesterday with this classical dichotomy. That means if we really say quantity theory applies or it is just an identity, then we have the split between nominal and real variables, because then money is just only within the transaction process in between. And then money would be neutral, and there I made I showed you this example of Adam Smith. Well, we are just changing the colors of the color of our money and say it is twice as valuable as before. What will happen in our economy? And then there's a good argumentation that if everybody knows this, that nothing would happen. And this was also always the discussion within the last crises we had. Because then it was also, what should we do? What should we do? Well, we have to push demand. How can we push demand? We are giving everybody 500 euros to pay their energy costs. Well, the argumentation would be then still the same. If everybody has additional 500 euros, then just the prices of electricity and gas will rise. And there then we can somehow distinguish between the short run view and the long run view. And this is so-called money illusion. That we, in the short run, more or less only see in our bank account, well, 500 more. So I'm going downtown and I go shopping. And this then will, of course, have a real effect if I start an additional buy of a bicycle or something like this. But in the long run, we should not be surprised that this push then will start to rise the prices. Okay, then we want to come. Now we have defined money. We have said what is money, the impact of the quantity theory of money. Now we want to talk about how is money created. Well, the first step, of course, is printing cash money. And there, by law, we are allowing this the central bank. But also, of course, a central bank is still a bank. So we then can just look at the balance sheet of the central bank. And so to speak, not only cash money, but the size of the balance sheet of the central bank is then more or less the starting point, the anchor of our money creation. And if we look then just at the assets and liability of our central bank, then of course on the right side we find cash money, currency in circulation. What else do we find there? We will talk about this further in a minute. By law, all private banks have to hold some reserves at the central bank. So this is an additional part, the deposit of the domestic banking sector. They have to deposit at the central bank. Well, and then we have some other liabilities. There, of course, we have also the part where the members of the Eurozone, which own the central bank, give the central bank some, so to speak, starting money, and this is roughly for the ECB, I think 10 billion euros around, so not that much. And on the other side, of course, we have the foreign reserves. We have credits, which they are giving to the domestic banking sectors, and other assets. This is, of course, also some stocks, some securities we find there. And then the creation by the central banks functions that I will more or less start to buy or to sell mainly the foreign reserves. So I'm starting to buy US dollar, then my balance sheet would be longer. And if I do it the other way around, then I will limit my balance sheet. So this is more or less then the direct process. And I don't think today, but next week, then I show you also what is the size of the balance sheet of the ECB. Okay, but we've already learned this is not the only money we have, because we are just paying with our banking card, credit card, with our accounts we have in the internet, where in behind there is our banking account or our credit card read in. And therefore, and this is the main part, money creation functions via the financial sector, via the private banks. And yeah, how does this work? There we can say, and I think everybody of you has some account at a private bank, and hopefully there's not a minus sign but a plus sign. Well, and what is the bank are doing with this? They are take this money and they are handing out credits to another person. And now think of this process. You have maybe 1,500 euros in your banking account, and then the bank takes this and gives a credit to some other person of around 1,000 euros. So then you are still acting in your consumption, in your investment, as a person which have in behind 1,500 euros. The other person which got the credit, well, why? He wants a credit, he wants to buy something. So what happens with this 1,000 euros? Let's assume his banking account is at another bank. Then we have there another account with another 1,000 euros. So this guy is then acting as somebody which also has 1,000 euros. And this process then goes on and goes on and goes on. And this we call then the multiplier process of creation of money. Well, but by law, then we say that if you have a deposit of 1,500 euros, the bank is not allowed to give 100% of these 1,500 euros sorry, as a credit. Well, and the reason behind this is still your money. And you, of course, are allowed to go tomorrow to the bank and say, well, I need it. I want to buy a new e-bike or something like this, so I need it and I take it. And if then the bank has to say, oh, I'm sorry, the money is gone because I'm giving a credit, then you say, this is not very good. And then you are talking about this to other guys, and then they all say, oh, I have also to see if my money is still there. And what you then have is that something like a bank run can occur. So something like an insurance against the bank run, we say they are not allowed to give 100% away. And then we will look at this process. What does it mean? How many side deposits we talked about is just money because we are buying with our banking cards. How is money then created? And this we want to do by an example that we start with one first bank, which should have a deposit of 1 million euros. There we can even think of they got 1 million from the central bank. Since we have to do some little calculations, I will shrink this. So, what happens then? At the first commercial bank, we have a deposit of 1 million euro. And we said we have a reserve ratio of 10%. How much credit they will then give away? €1 million as a side deposit and 10% reserve ratio. How much credit can I get then from this bank? €10% from 1 million is 100,000 euro. So how much is left? 900,000. No, only 900. 10% is 100. So this is a credit to some other guy, and there we assume he has his banking account at another bank, commercial bank too. So at this commercial bank, then we see a side deposit of 900,000. This second commercial bank should have the same reserve ratio, 10%. What is the credit volume then of this second commercial bank? 9 times 9 is 81. Thank you very much. And now this process should go on. The third commercial bank has then a deposit of 107.29. Thank you very much. The last one, 74, 729, and so on and so on. So all these are side deposits. How much money do we have in the end? We started with 1 million. Now we have to add up every amount of these deposits. So in theory, this process goes to infinity. So we have to add an infinite number of positive numbers in euro. How much do we have? Is it infinity? Yes, great. And do you also know which mathematical process is behind this? Hmm? Great. This is definitely right. So, and my question also, do you know the name of the mathematical process behind this? About this process, we talked very, very much during the pandemic. Because think about Corona. What we were talking about, well, how is Corona feeding through our society? There we thought, well, the probability that the next one gets Corona if he meets me, I already have Corona, is maybe 10%. And then we said, well, how many people do I meet during some time? And this is more or less the same process as we have it here. 90% we are giving away. So, and do you remember what it was called? Pardon? Compound investment? Well, this is still it has something to do with it, but behind this is also the same mathematical process. Yep. Yes, exponential growth, or if we take here our finite steps, then we call it geometric growth. So all this is geometric or exponential growth, and maybe also you see here why in the other topics I always also talked about growth, growth, and growth. We will have it in another, and you definitely said that 1 million plus 900,000 plus 810 euros plus 729 plus and so on is equals 10. No, 1 million we had at the starting point. 1 over 0.1 million euros is 10 million euros. So should I end here and not explaining the process because everybody knows it? No? Okay. Then we will rewrite these numbers here. How did we obtain these numbers? These numbers we obtain as 1 million times, and now I take my 0.9, 1 minus reserve, to the power of 0. Why to the power of 0? Because we are starting with 1 million. And then we should end up with 1 million. And this you hopefully have learned in school, that any number without 0 to the power of 0 is not defined, but any other number to the power of 0 is defined as 1. So this is multiplying 1 million just with 1. How did we obtain the 900,000? Well, this was 1 million times 0.9 and now to the power of 1. because 0.1, 0.9 up to 1 is 0.9 still. How did we obtain the 802? This was 1 million, not 1 million, this was 900,000, the deposit of the second bank, 90% of it, so 900 times 0.9. But the 900 we obtained by 1 million times 0.9. So here we obtain 0.9 to the power of 2. And the last one, of course, we had 1 million, 0.9. 729 is 90% of 810. 810 is 90% of 900. 900 is 90% of 1 million, so to the power of 3. Plus and so on. In the end, we can take out the 1 million at every part of our sum. This is, I think, class 3 in school. Well, actually, I learned, although my eldest son, now in class 8, during all classes in school, he had the highest mark, 1, in mathematics. And yesterday I asked him this, and he didn't know it. So for this, well, let's go just here. Oh, this is not possible. In the annual report, can I highlight this? Investing into the future. Well, and what should we do in a country where we have no, so to speak, first products? We have no oil, we have no steel, we have nothing like this. Then I think this means investing into education. And I don't know where our education is going in Germany. So hopefully you are doing the right thing. Actually, many of you doing now an additional thing with these studies. I think roughly half of you are German speaking, and then you have English lectures, and also other ones of you. I think we had Russia, we had something from somebody from India or so, and so you are also now practicing a second language, and this is, I think, a really good choice. Pardon? You are investing. Yeah, well, you're definitely investing in your future right now. Then we can also take the opportunity cost argument. So you are sitting here, you are getting nothing in money for sitting here. You even have to pay at least a little amount for sitting here, and this will last 3-4 years. You are sitting here, and this you have to compare. Well, I could have started to work and earning money during these 4 years. Well, why you are doing this? Maybe you are doing this because you have thought about net present value. About this we talked already, because I think your expectation is that your future income will be higher if you are investing today the time. Hopefully, or? And this is maybe the reason you are sitting here. So that today you are not earning, let's say, 40,000 euros a year for 4-5 years, and that in the future your overall income over lifetime will be higher than if you directly have started a work. Well, on average, this is true, but sorry, only on average. And hopefully you are in the distribution in the part where it is true. Okay, but sorry, let's go back to. But we have talked about net present value, about opportunity cost. This is maybe quite good also to see that everything what we are doing here is quite relevant. So, but mathematics, we are taking out the 1 million, and this means 0.9 to 1, 0.9 now to 1, to 2, to 3, and so on. And this is called then, we have it here, geometric or exponential growth. This is the so-called geometric series. This is class 9, class 10. I don't know if they do it today in school, but I have done it during this time. And there you also have shown then that although it's infinitely, it is an infinite number of numbers you are adding, that still this series has a finite limit. And you can show then that this geometric series is just 1 over 1 minus 0.9. So this factor here you have to take down, and then we can rewrite this. How did we obtain these 0.9? This is directly related to our reserve ratio. So this is 1 minus, and now you have to be careful because now you have a minus bracket. 1 minus 0.1. So 1 minus 1 is 0, and minus 0.1 is plus 0.1. So we obtain 0.1, and this we had here. And then, in general, we can say this is 1 over r, and this then means, so to speak, our 1 million is leveled by the factor of 10, and this factor comes from the inverse of our reserve ratio. So the inverse of the reserve ratio is then called the money multiplier. The inverse of the reserve ratio, R, is called the money multiplier. So I don't know which one of you remembers when you have showed this in school that this is true. This you had to prove. Well, actually, I have done this proof when I have studied economics, but this I don't want to do with you, but I will give you a hopefully intuitive argument why this is a finite number. So let's look at a square of length 1. So this length is then maybe here our 1 million. So the area is 1 million, so to speak. And now let's think not of a reserve ratio of 10%, but of a reserve ratio of 50%. What will then the first additional part? 1 million times 50% is half of it is 500,000. What would be the area here? The area here would be that we have to add to the starting square a rectangle which is just half of it. This represents our 500,000. The area of this rectangle is just 0.5. And then we go on with the process. 0.5 or 50% of 0.5. Which kind of area is it here? This would be just the upper square here, for example. So we add this square. This has an area of 0.25. 1/4 of the original square. Then we go on. 50% of this square is this smaller rectangle. What else? The next one. Half of this rectangle. And now I think you can intuitively see, although I'm adding an infinite number of areas, that what I get is only just, and so on, another square. So in the end, then I have an area of the starting square with length 1 plus like these carpet of little pieces. And if I put this in general into this formula here, 1 over 1 minus 1/2 is 1 minus 1/2 is 1/2 itself, is 1 over 1/2. Inverse is 2. So 2 times our starting square. Well, and then hopefully you see also intuitively that this more or less, or this argumentation doesn't depend on the size of 50% of the reserve ratio here. If I have a larger one of 70%, then it would be less than the additional square, and if it would be smaller than 50%, then I would just have more. So hopefully this is an intuitive argumentation that this number of the geometric series is a finite number, and it is not that surprising. Well, in the tutorial, in the first sheet, the guys of you who attend this, I think he has also talked about this part. Yeah, because we will have in the theoretical part of this lecture later on again have the same argumentation as we have it here, and hopefully you also remember that you have had this mathematical process not only in the introductory lecture of mathematics, but also in investment in controlling somewhere else, because they are everywhere. You have these processes, and especially if you look at net present values, where you said just I plus I1 over 1 plus R plus I2 over 1 plus R squared plus and so on and so on. You see here, down here, there, the factor is then just 1 over plus 1R to the power of n, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and so on. So, very surprisingly, in every credit process or so, well, this is nothing else than a growth process. So technically, you always have the same process. Yep. Money multiplier. Yeah. And I know my writing is not the best. We have it here on the next slide too. Okay. Then let's go back, or let's come now after we have talked about what is money, how money is created, demand for money. Now we will come to monetary policy. And there, let's remember our aim of the central bank, and that we have this aim of 2% in a symmetrical way. And this is what the central bank, the ECB, wants to achieve in the medium term, that inflation rate is around these 2%. So actually, what the central bank then wants to do is that these fluctuation around the long-term trend, our potential growth, so the business cycle, should not be that large, because also we argued that within this business cycle, in the boom phase, we quite often have very high inflation rates. And in the crisis, we have low inflation rates or sometimes even deflation. This volatility should not be that large. So, what is monetary policy about? Monetary policy is about reacting within this business cycle, that we do not have very extreme phases. And how does the ECB is doing this? And there I distinguish two kinds of possibilities: the so-called classical monetary instruments, and then we will also talk about monetary instruments we invented just after the financial crisis, during European debt crisis, during Corona, and so on. So, the main classical instrument is also called main. These are the so-called main refinancing operations. And there we already talked about the reserve, that by law the commercial bank have to hold central bank money. Well, and for this money, in general, they have to pay an interest. And this central bank money is given out via these main refinancing operations. And the interest rate of these main refinancing operations, this is then our key interest rate. Because you have to think about this in the practical manner, that the commercial bank, they are doing their business every day. And due to their balance sheet, they always have to change their amount of central bank money. So every day, every week, every month, they need central bank money. And within this process, the central bank gives out via these main refinancing operations, weekly, monthly, the central bank, and they give it out with this key interest rate. Well, and this cash management process in the commercial bank is dynamically, then we can think of that, in quotation marks, the cash manager at the commercial bank is doing some mistakes. Maybe then he sees, well, my balance sheet is too long. I need more money than I've got from the central bank. And then we have the possibility within the so-called marginal lending facility, that if I see, oh, oops, I need more central bank money, then I cannot get it via the main refinancing operations. This is done, but I can additionally go to the central bank and get additional central bank money, but now I have to pay a higher interest rate. So there is some corridor. In general, it is 0.5 basis points higher than the key interest rate. So this is one possibility to get them the money. And of course, this interest rate is then also a steering instrument for monetary policy. How large is this corridor? Do I take 0.5 or plus 1 percentage points? Well, in normal times, you think that within this marginal lending facility, you will find almost nothing. Because what does it mean? If a central bank, or not a central bank, if a commercial bank has to go to the central bank, oh, I need additional money. This means this bank doesn't get this money from their neighbor bank. And when didn't they get this money? If there is something bad going on. And so mostly the commercial banks do not want to use this instrument. But then we have to admit, within the financial crisis, the bankruptcy of Lehman Brothers, the sixth largest investment bank in the world, there was a deep crisis within the financial sector because the commercial banks didn't know, well, I don't know what is with my neighbor bank. And this financial crisis was so deep that we found within this marginal lending facilities during the last crisis amounts in 100, 200, 300 billion euros. And then we have the opposite instrument, the so-called deposit facility, because it can also be possible that I miscalculated my central bank money position and I have too much. So what can I do then? Then the central bank offers you can deposit at the central bank this money, but you obtain then less than the key interest rate. Well, and also this is in general not very attractive because additional money I can also in general invest at the private market. The private market has in general an interest rate roughly of the key interest rate, because with the key interest rate, the central banks want to steer the general interest rate, government bonds, within the economy. So again, opportunity costs. At a central bank, I get a lower interest rate than at the private market. Why should I do it? Again, in usual times or before the financial crisis and the other crisis further on, we found almost nothing in the deposit facility. Then, within all these crises, again, 100, 200, 300 billion euros we found there. And why did the private financial sector did this? Well, they just thought, if I'm investing in the private part, I don't know if this institution is tomorrow there. Which institution will be there tomorrow? Hopefully, or with a higher probability, the central bank. And maybe also you got some letters from your bank that, oh, I'm sorry, now you have to pay for your banking account. And the argumentation was, well, we have higher costs because during the crisis, the interest rate, especially of this deposit facility, was negative. It was around minus 0.5 up to minus 1%, and in Switzerland it was even, I think, minus 4%. And the argumentation of the commercial banks was, well, we have to invest for a negative interest rate, so these are costs for us, and I have to get the costs back from my customers. Well, actually, I then argued you were free to choose these negative interest rates. But anyway, we are back in positive interest rates, and so if you have more than 100,000 euro at your bank, you wouldn't be punished for this, I think, anymore. Okay, and then the last one we already talked about is this minimum reserve requirement, how much money I have to hold back within my house. And of course, this is also a monetary policy instrument, as we already seen this. If this reserve ratio is high, the money multiplier is lower, and then take quantity theory of money. With this, I have an impact in the long run, at least, on prices. Okay, now we want to talk, or since now I just talked about the interest rate level in general. But what we see is, of course, that we have different interest rates. And especially we have different interest rates for different maturities. If I'm giving my money only for 1 year to some other guy, there will be in general another interest rate than for a maturity of 5 years or 10 years. And now we can talk about the process why, at least again in the long run, this difference will lower during time. In general, we find there is a difference, but also if, in my case here, I started with a decrease of the interest rates, then the key interest rate, then what would be the direct impact? There we said these main refinancing operations are short-run operations, every week, every month. So this will have a direct impact on low maturities. So, and then we have again opportunity cost. We have here a decrease with low maturities. Still, the interest rates for the longer maturity investment positions is higher. So this is more attractive for us. So I will move my investment from the short run to the long run. But what happens then? The demand curve shifts outside. If the demand curve shifts outside, then I will get a credit with longer maturity for a lower interest rate, because there are much more people who want to invest in long term. So during time, then the interest rate of short run and long run will be in more or less the same value. But of course, this is still a dynamic process, also within the business cycle. So in general, it will be very seldom that we have for all maturities the same interest rate. In general, we have a difference, and this is called the yield curve. And about this yield curve, we will talk later on a little bit more. Okay, so now we have talked about that we have different interest rates, but over time they will be roughly the same, or they will be in the same neighborhood. So now let's talk, we have then there, let's say, an average interest rate level within our economy. Then we want to ask, since monetary policy is not about only money creation and changing the money, we want to have an impact on the real economy. And how are the reaction channels of an interest rate change then into the real economy? So there, let's again assume central bank is cutting interest rates, decrease. What does this mean? This feeds into the financial market. So the interest rates for credits in general will fall. What is the interest rate of credits? This is just the price for a credit. So the price for the credit is decreasing. What I'm doing with these credits, there, remember the circular flow. We talked about investment and consumptions. A relevant part, especially at the investment position, is financed via credits. And also in consumptions, we would also say that there, the lower the interest rate, the higher the consumption. So, but this and this we can compare with our GDP. There we said, well, this is nothing else than consumption plus investment plus government expenditure and exports minus imports. Well, if this is increasing, there remember this was the demand side view, then we could argue, well, this higher demand then will also push production, supply side. So we will have an increase of the utilization of production. Okay, then quantity is increasing, so this will then push economic growth in general. But then think of the concept of potential growth, of potential production. We increase. Then we come to the point in the business cycle at the limit of the capacity. When we are there and still increase demand, then prices, especially wages, will increase. This will increase the costs at the enterprises, companies. So then we come to a situation, since we are at the limit of capacity, that the real growth will start to stagnate. And since the costs are still increasing, profits in general will fall. So, and what we are now doing is, now we are coming more or less to the view of quantity theory of money. If we now still push via low interest rates, this means in the end just creating money. Then this will not anymore increase investment. And then this money will only cause inflation. So all this argumentation is then also dynamically, we come from the short run effect then to the longer run effects. And if this is true, if this argumentation is true, this we have to evaluate in reality, of course. And there is another, this is more or less then a direct effect. Prices of credits are lower, consumption and investment is increasing, and then the cycle starts. But here, if you compare this then with the speculative motive of money demand. We can argue in general, again, decrease of interest rates or key interest rate will in general decrease the interest rate level in our economy. So also the interest rate of our government bonds. But then we have this opposite effect that stock prices will increase because they, in the short run, are more attractive. So, stock markets are going to the sky. This process will last on until then the yield at the stock market will be again the same as in the bond market. Because then you have to pay a higher price if you want to invest and so on. We have talked about this when we were talking about the speculative motive of money demand. Well, now we have these high stock market prices. Well, the amount of stocks within the economy overall is, of course, a relevant part of total income. So there the prices have increased, so to speak, the owner of the stocks are now richer. So the income of investors will be higher, so our Y is higher. Well, and then we had the general assumption, if income is higher, then again, especially consumption is higher. This was the Keynesian hypothesis. And of course, in general, this I haven't done there, not to make it too complicated, but we can also think of that the same is true for investments. That we have also a positive dependence of investment and income. Well, and then we are more or less at the same point, at the starting point of the former slide. Via the capital markets, we can also argue after them argumentation that again consumption and investment is increasing. And then the same points we had on the former slide here will start. So you have then just to add these points down here, and after that, overall, if we still think this can go on and can go on, we shouldn't again be not surprised that in the end only prices will increase. Okay, so for the end today, I want especially talk about the yield curve. So the difference between the interest rates we find in the practical situations between long-term and short-term investments. Because at least in the long run, we argued due to opportunity costs, if one investment is more attractive than the other, then all people go there. The demand is rising, so the yield should then fall there, and in the end, we should have the same level of these interest rates. But in practice, we almost always find that these interest rates are differing. And this, or one possible explanation is the so-called market expectation theory. And in order to make this argumentation, as very often, we have to make quite strong assumptions. When will our argumentation, which I give you in a minute, will hold? Well, at first, very strong assumption is that long-term investment and short-term investment should be perfect substitutes. Hopefully you already know what are perfect substitutes or substitutes in general. This means I have two goods and I can just interchange these two goods, and yeah, for me it's no matter if I have the one good or the other one. For this, of course, we know that this is not fully true in practice. But so in general, we could think about, if we assume this, what would happen then? And also, our investors should be risk neutral. What does this mean? Well, if I make a long-term investment, then I don't know what happens during this time and do I really get out my money in the end? So there will be, of course, another risk than within a short-term investment, where I get at a shorter time my money back. But also on average, in this case, we assume that we do not differ between these two risk situations. And we assume that we have perfect capital markets. This means that all investment opportunities I will always have. So there is no liquidity limit or something like this. And there are no countries which are prohibiting me to invest somewhere. So these three assumptions are quite strong, but this is also from a theoretical way. And it is always good to make strong assumptions, to make the problem clear in the end. And now, giving these assumptions, we assume that we have one short-run investment with interest rate I1, and let's assume this has an interest rate of 2%, and we have one long-run investment with an interest rate of 4%, always per annum. And now let's see what do we get out of €1 with this short-term investment. 2%, then we end up with 2% of €1 is, you really have to use a calculator. Pardon? 19 cents? 2% of €1, 100 cents and 2% of 2 cents. So we end up with €1 times 1 plus 2%. This is 0.2, 1.02, sorry. So in the long term, 4%, what happens with our €1? First year, 4%. So, here we also have to assume that we have automatic reinvestment. So after 1 year, we have 1.04. Investing this 1.04 with 4% is again multiplying with 1.4%. So up to the power of 2. Well, this I cannot do in head. Let's do it. Just equals 1.04 is 1.0816. 1.0816. So, okay, if we compare these, actually, this is larger than this. Okay, this is more attractive. Or, well, if we compare these two investments, we have to ask, are these two investments now comparable? Well, we have said here perfect substitutes, perfect capital markets, and so on. Okay, but actually they differ in the period of investment. So right now we are just comparing apples and tomatoes or whatever. I don't know. How do you say it in English? In Deutsch, in German you say Äpfel und Tomaten, Äpfel und Birnen. So in order to make these comparable, these two investments, then we think of these perfect capital markets. In order to compare it, both investments have to last the same period. So the right one is 2 years, so we need also an investment possibility of 2 years on the left side. And for this, then we can say, since we have perfect capital markets, within 1 year, after I got out 1.02 cents, I can reinvest this amount of money again 1 year. So this then 1 plus 2%, reinvesting this now with a new 1 period, 1 year investment possibility. Well, and now this is the interest rate in 1 year. And unfortunately, I don't know where are the interest rates in 1 year. So I have some expectations about this, and therefore we have this E up there as an index. So this is the expected short-term interest rate in the future. So and now we take all these assumptions together and say now everybody, or on average, the people within the economy have expectations about the future interest rates. Then if the long-term and the short-term investment are perfect substitutes, we are risk neutral, and I can always invest the amount of money which I want in all investment possibilities. Then I can say if these two yields would differ, then again I start running to the right or running to the left. But what happens then? Running to the right, running to the left means demand is increasing on the one side. This means this dampens the yield on this side. And how much will this dampen the yield which was originally higher? Well, as long as the yields are the same again. So with these assumptions, we can make here an equality sign. But this is no law. This just follows from our assumptions. If these assumptions do not hold, we cannot write down here the equality sign. This follows from our assumptions. Well, and now we have where we economists are really, really happy. Because why we are now really happy? Here I have a number I know today. I can go to my bank asking, what do you give me if I'm investing 1,000 euros for 1 year? Here I have a number I know today. I can also go to my bank and ask what interest rate you are paying for an investment which will last 2 years. And I have this equality sign, and here I have a variable which I do not know, but in which I am highly, highly interested. I'm highly interested where are the interest rates tomorrow. So let's solve this now for the unknown variable. Therefore, we multiply these brackets here. At first, we can cancel out the amount of investment. It is independent from this. So we obtain 1 plus 2% plus I1I plus 2% plus I1E equals, what is this? First binomial formula, a plus b to the squared is a squared plus 2ab plus b squared. The 2b we just split. We say 2b is b plus b. So a is 1. So we have 1 plus b 4% plus b 4% plus b squared 4% squared. The 1 is cancelling. And now we have a look at these two parts of our equation. There we say again, if interest rates are low, again, remember the Fisher equation, lower than 10%, then we are here multiplying 0.04 times 0.04 is 0.0016. This is much less than 0.04 itself. So then we can approximately cancel out this. This was the same argumentation as we had it at the Fisher relation, where we said this a little bit complicated. 1 plus the real interest rate is 1 plus nominal interest rate over 1 plus inflation. We can roughly say real interest rate is a difference between nominal interest rate and inflation. And then let's move this on the right, and we end up with 1 I1E equals 4%, and let me write it like this, 4% and another 2 minutes. There we directly can calculate the expected short-term interest rates from information we have today, from the future interest rates for different maturities. So this is more or less the market situation of interest rates today. And from this, we can then deduce directly the market expectations where will be short-term interest rates in the future. And what is the dependence? Let's see, let's have a look at this bracket. This was long-term, and this was the short-term interest rate with the example 4 and 2%. If this bracket is positive, like in this case, then expected short-term interest rates will increase. And especially if this would be negative, then we would expect a downturn in short-term interest rates. And now let's at last put together our situation. When do we expect to fall, that the interest rate will fall within the business cycle? Which phase in the business cycle which will mainly correspond to low interest rates? Well, we argued low interest rates is a situation where the central bank wants to push economy. And when does the central bank wants to push the economy? In a boom? Think of the target, inflation symmetrically, roughly around 2%. If we still push within the boom, then the inflation rate will even rise. So we want to stabilize our economy within a recession. Then we are moving in and cutting interest rates. So if we are in a situation where we have that the short-term interest rates are lower than the long-term interest rates, this is a signal for us that the market is expecting a fall of short-term interest rates, so that the market is expecting that central banks will cut key interest rates. And when does the central bank will do this? When we are maybe in a situation as of a recession. So what is the great outcome from this view here is that we have here a recession predictor just from market data. And the maybe nice thing or bad thing is that this market predictor is very, very good. If we go back the last 50 years, always just before the next large crisis, we have an inverse, so to speak, yield curve that the short-term interest rates were higher than the long-term interest rates. And here, about this we will talk next week. The yellow line is more or less the actual yield curve we have. And here, in the first part, we see a quite large inversion, that the short-term interest rates are much higher than the long-term interest rate. And therefore, I think we should not be very surprised that we are in a crisis. And still have a look at it if you make your own investment decisions. Okay, thank you very much for today.